We've researched the most commonly bought items that you go out and buy. Let me emphasize, it is not scientific. It is absolutely not scientific, the sort of things we've got. But they are the things that people are buying all the time. So, for example, we've got rice from India. We have cheeses from the EU. In this case, my producer will be delighted. It's Irish cheddar cheese. We have vanilla from Madagascar. We've got clothing that's made in all sorts of parts of the world. In this case, I think these are made in Kenya, but they're from all parts of the world. And other household items, the obvious ones, toilet paper. We'll be looking at TVs and iPhones, and possibly the two that you might see almost immediately, bananas and coffee. Now, all of these items that we have before us, we will continue to monitor on a regular basis and let you know just how we are seeing the actual prices change. While I've been talking, hopefully we've put another 5 cents in the meter, another quarter, and Nathan's back with me. We paid the bill, sir. We paid the bill. Listen, what's your recession forecast?
It's rising. I'm not sure I'd go all the way to 50%, but 30 to 40% recession odds are very plausible here. This is an enormous shock to the U.S. economy and to the global economy.
The idea of how this plays out, I'm desperately trying to that neither of us ends up going down the politics route, but the U.S. economy was in good shape. Now, as the longer these tariffs remain in place, economically, not politically, economically, what happens?
Well, we're seeing damage in the equity market that's causing people to pull back. There's a lot of uncertainty in the corporate sector about how much various inputs are going to be, how they're going to be expensed going forward. There's uncertainty among individuals and households about how much stuff is going to cost. And so you are increasing the uncertainty premium in the economy. And it's going to take a while to rebuild that confidence, even if President Trump were to pull back on these tariffs tomorrow.
And on that point, this a bit the way companies will be pulling back on expenditure, the whole sort of how long have we got, do you think, before the damage is so deep, confidence-wise, investment, market-driven, wealth effect, whatever dimension? How long before it's so deep that that it's almost very difficult to come back from?
That's a very hard question. I'm worried about the uncertainty being disruptive in the near term. But if this persists even for, say, 3 to 6 months, you're going to start breaking supply chains. You're going to start disrupting production patterns. You're going to cause firms to lay off workers. And coming back from that, as we saw during the pandemic, is a long, drawn-out, painful process. So we're not there yet, but we're going to get there pretty quickly.
And the idea that it's going to reverse an industrial policy and bring jobs back. The president seems to think that it'll be sort of 18 months to 2 years. Everybody else I speak to says it's going to, if indeed it's possible, it will be much longer, because throughout this process, that level of uncertainty maintains. You just don't know if it's going to change.
Yes. As the president said, it takes years to build plants. And then the employment's going to come most likely after that. But an important point here is one of the reasons why so many manufacturing jobs went abroad is the U.S. workers understandably have high expectations for what they're going to get paid. So at U.S. wage rates, how many firms are going to actually be able to significantly increase employment? Maybe it comes back more as an automated form, more robotics, more capital intensive. So in my mind, there's a real question as to how much new manufacturing employment we actually get.
Nathan, I'm grateful. We'll talk more, particularly as we get those forward-looking indicators like consumer sentiment and all those surveys and at the factory gate. Thank you, sir. I'm very grateful. Thank you.